Welcome to the daily update, where I'll go over the action in the market for Thursday, May 22nd, and we'll see how things look for Friday, May 23rd. All right, looks like we were gonna get a little bit of a bounce. The market seems to have stabilized anyway, but we saw some late day selling coming in that actually took us down back negative, and not an awful lot of conviction in Thursday's session, not as much as what we saw on Wednesday, but at least we're not continuing with these substantial declines. Things seem to have stabilized a bit in the bond market. We're still concerned because we're above 4.5% with the 10-year yield, but we did shoot up higher, but then we're able to come back down and at least repair some of the damage in the 10-year yield. When we get above 4.5%, that's when the stock market really takes notice, and that causes some concerns. Okay, so right at the open, we did have a lower open, not a real big gap, but then we just chopped them above and below the unchanged level. Not an awful lot of conviction there. Then prices rose back and actually got above the daily pivot at 58.71. It looked like, okay, maybe we're going to be able to break a little bit to the upside. We got up to 58.75, and then right after that is when we saw the late day selling. It drove prices back down, and we ended up closing slightly negative. So we were down 0.04%, virtually unchanged, but it goes in the books as a down day. We're still below average with volume, but that's the typical thing that we've seen over the last few weeks. When we were really coming down in April, volume was massive. As we've been coming back up, most of the time we've been seeing volume below average. And we are still positive in the short, intermediate, and long term because we're above the 20, 50, and 200 day moving averages, even though we're still in a downtrend in the long term. The 50 period moving average is still below the 200. And it's kind of about interest rates right now. We'll see if that it came in, everybody was freaked out about it. There was a bond market, kind of a mid-level bond market auction that wasn't well received. I think the market wanted to go down anyway, and it used that more of an excuse, but it has been shooting interest rates back up. We'll see if that continues or if that is pretty much in the rear view mirror now. Not an awful lot really coming out as far as tariffs and trade wars. Just there's still a tendency to be a positive backdrop with that, but we're seeing a general shift over, at least in Wednesday's session, where we were turning a little bit more negative. It seems like whatever news was coming out was treated as bad news. Seemed to have stabilized a little bit on Thursday. We'll see if that continues as we go into the last trading day of the week before a 3 day weekend. So, some comments. The House did pass the reconciliation bill. Now, whether you like it, hate it, it does add to the debt, but it also puts some things in there that some folks think will be more beneficial. It raises the SALT deduction cap to 40,000 where it had been at 10,000, and it moves up the Medicaid work requirement from 2026 to 2029. That's to reduce some money there. Increases the debt ceiling by 4 trillion. My gosh, when we were going through the great financial crisis, the bailout package was just under $1 trillion, and everybody thought that was astronomical. Oh my gosh, 800–900 million dollars, and now it's like we don't even really talk about it and think it's that big of a deal unless it is into the trillions these days. And then the tax foundation estimates, and this is always going to change, but personally, I'm really suspicious of things that say, okay, we're going to cut spending over the next 10 years, or this is going to add growth for the next 15 years, or whatever. Something's going to happen to get in the way of that. It's really just to appease people right now, to give them something, okay, this is what it looks like it's going to happen. But it ends up always changing along the way. But there is an estimate out there that it will increase long run GDP by 0.6%, and it'll add 3.3 trillion in deficits over the next 10 years. Of course, that would probably be good news. It's probably going to end up being like 10 trillion or something. Okay, then the 10-year yield, we're still above 4.5%. We're at 4.55%. We're also keeping an eye on the 30-year yield because it bumped above 5% and it came down, but it's still at 5.06%. Growth stood up a little bit better in Thursday's session. It actually outperformed. We're still above 20 with the VIX, though. We're coming in at 20.28. Pretty short list now with those things that are looking extreme positive in the short term. And the slope oscillator is actually negative. It's still in extreme territory, but it's crossed below its moving average. The stochastics are also coming down. But our other short term indicators that we look at really aren't showing much conviction. They were all extreme positive, showing good short term momentum. With the down day on Wednesday, those all got worked off. Intermediate term, also, really the things that are on the list right now are those that are a little bit slower. The momentum oscillators, like the PMO, and then the whole list. The TTM squeeze still is extreme, but negative now. And the bullish percent index, that's actually holding up quite well for the NASDAQ 100. Not as good for the S&P 500. And no change to the overall Fed scenario. They're just kind of going along, seeing what's going to come about with all of that. The dollar did bounce a little bit. We're still under that 100 level, though, and interest rates did decline. We were at 4.6% after Wednesday. We closed at 4.55% after Thursday. We didn't change as far as sentiment. It was virtually an unchanged day. So we were at 66. We're still at 66. That's positive. So, but the context is that we've been coming back down with sentiment a little bit there. We're back to not trending again. We dropped below 20 with the intermediate term chart. We're dropping below the moving average. So it suggests a weakening trend right now. It looked like we were just getting ready to start a confirmed trend, and everything confirmed and everything was getting stronger as far as the trend. And then we had the down day on Wednesday, the bit of a follow through on Thursday, and that's kicked us back down to where we're not trending right now. And because we not only Wednesday but Thursday ended up being down, the bias is negative, and I've switched our momentum to mixed. It's like the market is lacking a bit of conviction right now. Okay, so we did get probably most of the reports that were important for this week came out in Thursday's session. We're still hanging in there with initial jobless claims. They actually came in lower than expected. So we're not really seeing employment falling off a cliff here. It came in at 227,000. They thought it would come in at 232,000. Continuing claims did tick up. We're back up into the 1.9 million range now. And I just look at the numbers for this. I have charts of the jobless claims coming up. But the preliminary global U.S. manufacturing, the one that we really focus on is just, it's mainly focused on the U.S., where this is more of a global here. And it's a PMI. And the takeaway is that it came in above 50, 52.3, and that's up from 50.2. So manufacturing is actually picking up. Services actually came in above 50 as well at 52.3, where the last time we had a reading of 50.8. So we're still seeing growth in that aspect with both manufacturing and services. Existing home sales, some of this has to do with interest rates going back up, probably. We were down 0.5% on a month-over-month basis. Annualized, it's at 4 million units there, lower than the 4.15 million that they had been expecting. And then last time it came in at 4.02. So we're right around that 4 million level there. And when you look at the period a year ago, we're down 2% from there. So, okay, here are the jobless claims. We're still going up with the moving average, but the number is coming down. And we still are in not really a range here, but we're just not seeing any real breakout either to the upside or massively to the downside. And I take this as good news. We're not really seeing any real waves of initial claims coming in. This is where we're going back up, kind of the breaking out a little bit of the range here. We're back into the 1.9 million category, and the moving average is going up. So we not only watch people that are filing for the first time, these are people that stayed unemployed for longer periods. Putting it together, the red line, these are the initial claims, which came down. The continuing claims are going up, and then also the latest reading on the unemployment rate at 4.2%. All right, and this is put out by Real Investment Advice. It's kind of a convoluted little chart here, but it's the Economic Output Composite Index, where we did get LEI earlier in the week, and this red line actually shows it going up, where really it's been coming down. And then the index itself is actually dropping down a little bit here, but we're not necessarily falling off a cliff. We're not seeing real big declines at this time. We'll keep an eye on this and see if it does change. But if this was really going down, then we would have more fear of going into a recession. Then the short interest. These are folks that think that the market's going to go down, and so they sell to get in and they have to buy to get out. And if we're really going up, especially near the close, and the market just seems to be out of control to the upside, that's often due to short covering or a short squeeze, and because they have to buy to close out their positions. It's still not very high. It's at 2.3%. Now, there are other alternatives, and in fact, in the program that I have, I teach about those alternatives where this is very risky to go straight into the market and short it, and you've got all these extra requirements that if you get into either put options or inverse ETFs, they're a little bit safer, where you virtually have unlimited risk when you try to short the market, because theoretically it could go to infinity and beyond there. Now, one thing that we are seeing that's going up here, and this is the other side of the coin that whenever I see this chart, I try to explain. Remember, they had to sell to get in. That means they have to buy to get out. And so there's built-in buyers here. But it's still not all that much, but this can have an impact on the market. If we really start going up, these folks, they don't have a choice. They have to get out of the market, and so they have to buy to close out their position. And this can help prices to actually go up. Okay, then global market implied the equity risk premium. It's still pretty low right now when you look at all of this. And it just, when this goes up, that tends to mean that, okay, how much extra compensation are we getting for owning this stock? Because when people buy stock, that's called risk on. They're riskier investments when compared to bonds. Well, not in Wednesday's session, but those are considered to be safer. And so when these lines are going up, that means that folks, okay, they're being compensated more for the risk that they're assuming, and we're still getting pretty low readings with this. This looks at the whole world with the US in green here at the bottom. Okay, then this is trying to put another valuation on stocks. They look rich in real terms. Real usually means that they've calculated inflation into the overall equation. And this is the S&P based on a rule of 20 using a forward PE. We're above that level now, but I point that out in every weekly video, and we've been getting lots of charts with this. And we're also seeing consumer sentiment has been rather dismal lately with the inflation expectations looking out into the future. They think inflation's going to go up. And so down here, they say stocks look even more overvalued using expected inflation. So usually they like to have the yellow line and the white line here pretty close to each other, and they've kind of become disconnected with each other as well. All right, then 50% of large cap mutual funds are outperforming their benchmark, and that's common. 2025 has been very challenging. So if you're just getting into an index fund, that's attached to the S&P 500, it's not doing very well. But if you're in a managed ETF or a managed mutual fund, well, those folks that manage them, they have some latitude. They can do some maneuvering. And when we have difficult times in the market, the managed areas of the market tend to outperform. Where if you're just doing a systematic approach to investing where you're just putting money in the S&P 500 or NASDAQ or in the Dow, well, you're just going to go with whatever the index does. And when the index is having problems, that type, what's called passive investing, usually doesn't do as well. When the market's under pressure, then the acting part of investing actually does, it outperforms during those times. And we're seeing that happening so far in 2025. Then announced buybacks over the last 3 months and then a percent of market cap. We like that this is going up, especially in tech. That really helps when tech companies are coming in and they are saying, we're going to buy back our own stock. Not an awful lot in energy or utilities, but we see the financials, communication, discretionary, these, not so much financials, but we want the financials to do well. But the three big growth areas, discretionary, communication, and tech, when those companies are coming back in and at least announcing that they're going to buy back their stock, that's a positive thing. Now, whether they actually do it, there's a lot of announcements that are made that are not followed through on. And then we have other charts that we see periodically that points that out. And then the dollar breaches a four-year-old bullish trend channel. Okay, we had a trend line going up here. We actually fell below that. The dollar's been under a lot of pressure lately, and it is oversold right now. We're seeing if we can get some kind of a bounce from that. And then hedge funds, gross and net leverage. We're looking at gross exposure. That's the light blue line here. They're quite exposed right now. And then their net exposure here is over here in the dark blue. And this is basically is trying to tell us how much risk are these hedge funds taking on right now. And then this is the chart. I don't have it in this video. I'll go over it in the weekend video. This is what we call the spread between risky and not as risky bonds. This is just a variation of the chart that I show quite often. When we were really going down in early April, this was starting to go up, and we were watching that chart very closely. Since we're coming back down, that means the risk is coming out of the market in spite of what happened on Wednesday. And so I haven't been showing that chart as much as we were before. And I use it as more of a sentiment gauge of the bond market. It just shows that there's some fear coming out of the bond market now. And that's positive. All right, then Treasury yields have been a catalyst for sharp equity moves, both up and down. You can go back over here, and we're using the 10-year yield on on this, where we go back a year ago where some recession fears started coming into the market. And then we saw interest rates going up. And then the Fed came out and said, we're going to have rates higher for longer. Then, oh no, we're going to have a soft landing. Then higher for longer. Recession fears started to spike up again, higher for longer. You can kind of see we're forming. I'm not a big pattern person, but this looks more like a wedge type thing that's being formed here. And it just shows that even though we look at the stock market and that's where we're the most active, we still want to keep an eye on the bond market because it's stocks and bonds and they are interrelated to each other. All right, and then reserve status. This is more historical, where I believe this is Italy here because this would have been around the time when they were the dominating force in the world. And then you had Portugal, that was 1300s to 1400s, Portugal, then Spain, the big um, folks that went out, like Christopher Columbus and the explorers. My goodness, I couldn't think of that word. The Netherlands, and then France was up there for a while after their revolution. Then the UK at the beginning of the 20th century, the sun never sets on the British Empire. Well, then after kind of a going from World War One after World War Two, that's when the US pretty much became the world's currency. And of course, there's a lot of debate going back and forth. Is this going to change? Are people going to start switching out? And will the U.S. eventually lose its reserve status? You can make a case for either side. All right, so here's the chart. Very choppy day. We did open lower, negative, and then we went up and came back down and went up and came back down, just chopping above and below the unchanged level. We saw a little bit more conviction later in the day where we tried to get up to the daily pivot. It looked like we were breaking out. And then with a half hour left in the trading day, we saw some selling come in, then a little more selling, and then enough selling to just take us down and actually end the day negative. All right, not a real big change in the futures that I looked at right before I started recording. And it was a pretty flat day, which is kind of welcomed because there a lot of concern was raised in Wednesday session when we saw that big downward move. And to see things stabilizing, that's more positive, at least how it looks right now. We're still looking okay here with the intraday growth to value chart. The blue line is still above the red line. And we're still basically going up now when we look at the S&P growth to value intraday chart. Looking at the end of day chart, the end of day charts where the growth, it was up where value was down. So growth did outperform in Thursday's session. We were down more with the mid caps and they were down with the small caps where value was up for the small caps. So we're coming down a little bit, but still overall, the trend for the small cap growth to value end of day chart is still looking a lot better, as is the mid cap growth to value chart and the S&P growth to value chart. We are in a downtrend here, but you can see the red line is starting to turn back up and it is improving in the bigger picture. Still above the rainbow when we look at the growth to value ETF, ticking back up a little bit above both the moving averages when we look at discretionary to staples. And we're not quite below 20 in the short term. We've already switched back to dropping below 20 in the intermediate term, but we are dropping below the moving average here. So we're drifting into a trendless environment again, where it looked like we were just coming out of that environment. And this is where we're actually dropping below 20. We're below the moving average. We're positive though because of the green line, but the green line's coming down as well. Still below average with volume. You can see that with the exception of just a couple of days, we've been below average going back to about the middle of April. Finally, when we seem to stabilize in the market a bit there. We're back above 20, still above 20 with the VIX. And this is incorrect. We're actually above 20. I didn't change that there. And this is when things are a little bit more negative. We tend to see negative annualized returns when we're above 20. We see positive annualized returns when we're below 20. The VIX of the VIX also still coming back up to its moving averages, but the moving averages are still declining. That's showing a little bit of stabilization there. But we're starting to turn back up with the momentum as measured by the MACD. We really were coming down with the VIX, and now it's starting to turn back up. And so we'll want to keep an eye on that. If we keep going up with the VIX, that will probably mean stocks are going down. In fact, almost all the time, that's what it means. So we declined a little bit with this fear gauge, but we ticked up with this other fear gauge. So not a real confirmation there. And you can see this. Wow, we really went up with the one-day chart of the equity put call ratio. A lot of hedging going on here. And we're going back up with the 5-day chart after being extreme negative. Now, when this is coming down, that's more positive. When this is going back up, that's more negative. And we're starting to turn up with the longer term chart based on 10 days here, where we had really been coming down. Now it's starting to go up as well. And that's worth watching because that could end up being more negative. We've got the latest reading of the individual investors. They're finally, for the first time in 2 or 3 months at least, where they're looking a little bit more positive than negative, but right now they're neutral. They came in at 1, where we were camped down here in negative land for like 10 weeks, I believe it was, and then we improved a little bit last week, and now we're finally turning a little bit positive with the latest reading here. And we're coming up into the range now. We're seeing a bit of a pickup with the volatility risk premium, a little bit of fear starting to come back in the market. But we're still looking okay with the advanced decline line. Now, we did go down based on price and volume, but we're above these advancing moving averages. And we're seeing a little bit more weakness here with the 10-day advancers decliners. That's coming down, and we're actually just starting to drop below 0. So that's turning more negative. Coming down with the advanced decline ratio short term, the blue line had actually become extreme positive. It's really been dropping off. And the red line's still rolling over, but both are still barely above 0. And seeing a little more of an expansion of the new lows and a real contraction of the new highs, that's causing the 5-day moving average now to go down. And we're flattening to slightly declining with a 10-day moving average. And again, it depends on how you look at this. If you look at just the accumulation distribution itself and where the moving average is, we're positive, but we have been coming down. And then the boom indicator, it's starting to roll over. It's below its moving average. So if you're more aggressive with this chart, you would consider this to be negative, even though we're still above the red line. But other ways you could look at this is that we're positive in one aspect, negative in another aspect. So that's a non-confirmation. And we're starting to roll over with the Chaikin money flow. The histogram did drop, and the red line is starting to roll over there. And we're negative with the Chaikin oscillator. We're below the moving average after getting extreme. This continues to come down. So depending on the first chart, the second and third chart, we are negative with the smart money indicators. We're coming down with the green line, but we're still positive here with the vortex, and we're declining with the advanced decline line studies, but we're still above these moving averages with small caps looking closest to their moving average now. They could actually drop down below it if we have another down day. And working off this extreme reading of those stocks in the S&P above their 20 period moving averages, we had become extreme, started to work it off a little bit, became extreme again. Now this is coming down, but we're still above 50. But the context is that this is declining, also declining with the 50 period moving average study, the 100 period moving average study, and we're actually dropping back below 50 longer term. So this is longer term negative when we go below the 50 level. Here's the daily chart. We're looking pretty good. We actually broke above this resistance, and then Wednesday happened and we started to come back down. We're still trying to figure out, are we going to come down and try to fill in this gap here? Or are we going to be able to recover and then just keep going to the upside from here? And we continue to drop off with volume. We're no longer extreme with the 20, 50, or 200 moving averages, but all of them are still above 50. But the context is that they are declining. And the Stochc RSI dropping below the midpoint. We're no longer extreme with the Williams percent R, the CCI 14 and 20. The stochastics were coming down in the short term. We're no longer extreme in the intermediate short term, and now we're rolling over below the moving average with the long short term, but we're still extreme positive. The force index is declining, but still above zero, so it remains positive, but the context again is that it's going down. Seeing a little bit of weakness developing here with the short-term trend. We've fallen below the green line and the blue line, and they're starting to roll over just a little bit here. And we're right on the border still between the +1 and +2 channel with our standard deviations chart after we got way up high into the +3 channel. Intermediate term declining, but still above zero with the balance of power coming down and just kind of hanging out around this fluorescent green 10 period simple moving average. But the lines are still going up for right now, although they are slowing down a little bit. And we're switching more to neutral after having been positive with the go, no go. That's the dark blue. When they switch to light blue, that's a warning sign there. And coming off of the highest high value still, that's the blue line on top, but we're still above the midpoint. And we're still positive with the Landry light. We're positive with the proper order. TTM squeeze is actually turning negative, but it's still extreme positive. We had this massively high reading, and that's when it's light blue. When it turns to dark blue and starts to decline, that is more negative, and this gives you a longer term perspective. We had just this massively high reading that now we're coming down from. Dropping off a little bit with standard deviation, we're just still a little bit above the moving average here. If we drop below the moving average, that's when I stop showing this chart. When we're above the moving average, that means that we're moving quicker. But if we're below the moving average, we're more or less going sideways over the last 10 periods. And we're declining, but still above zero with the ease of movement. We're still positive here with the Arun. We're above zero with the oscillator. And we're negative for 2 days now with the McClellan oscillator for the S&P. We did see this negative divergence as we were going up based on price. This was coming down, and we dropped below zero. And so this has actually turned negative. And when that's below zero, we're now declining with the summation index based on price and volume after becoming extreme with volume. And we're below zero with the NYSE McClellan oscillator as well. And so we're starting to come down a little bit more with the summation index based on price and volume. We're starting to drop below the midpoint with the Swinland trading oscillator. This continues to decline and looking a little bit more negative right now. And we're rolling over a little bit with momentum, but these are slower indicators. We're actually dropping below the moving average based on price. We're coming down, but not below the moving average based on volume. Coming down with the PMOs that are rising, we've actually dropped below 50. That's a little more negative. The buy signals are no longer extreme, and we're starting to roll over with the PMOs that are above zero. That's in the S&P. We continue to be neutral with the Elder's Impulse system for the S&P, and for 2 days now we're negative with the parabolic SAR, and we're negative here. Even though we're extreme positive with the slope oscillator, very high reading, we dropped below the moving average, and now we're declining. We're rolling over, but we're still above the moving average with the MACD. So in the short term, we're looking negative now with the slope oscillator. starting to roll over with our other short-term oscillator, the TSI, rolling over with the MACD, just starting to roll over with the PMO, a little bit closer to the moving average with the PPO. We're still going up and we're extreme here still with the tricks in KST, the long-term oscillators. We're turning negative though with the Copic curve. We're dropping below the red line. And this is a longer term chart, just showing how we had become really high with the reading here. And now we're starting to back up off of that, back down off of that. And we're coming down a little bit more into this neutral area with the Sean trend meter. But we were going flat even as the S&P was going up, and now we're starting to decline. So there's still some weakness here. We're declining, but above 50 with the money flow and the ultimate oscillator. We're declining, but still above the moving average with unbalanced volume. Coming down a little bit, but still above 50 with the intermediate term RSI. And we're pretty much flat to slightly down here with the short term RSI. The intermediate term trend is still holding up because we're above both the red line and the blue line. So as long as we're above these lines will continue to go up. We're above all the plotted moving averages here. That's why we're positive in the short term. That's the 20 period moving average. Intermediate term is the 50 period moving average, and long term is the 200 period moving average. And we're still extreme with the S&P bullish percent index, but we're dropping down and we're below the moving average. So this is actually negative now. Coming down a little bit with the NYSE bullish percent index, and still extreme and rolling over a little bit with the NASDAQ 100 bullish percent index. Not showing any support or resistance right now because we're far away from the levels that we've been watching. Turning more negative here with the Heikin Ashi with the black candles. Still positive, but pointing down with the Kegi chart. It's positive when we're pointing up. Still positive with the Renko chart, but still negative with the three-line break. So getting a mixed picture across those measurements. Dropping a little bit further below the midpoint here with the 150 and starting to drop below with the 200-day moving averages. So we're still positive in the short term, where we have small caps negative in the intermediate and long term. Mid caps are still negative in the long term. Bonds are still negative across the board based on price. Commodities are positive in the short term. The dollar is still negative across all time frames. And this is rather encouraging on the day that we saw discretionary and tech, two growth areas, they were up, where all of the other sectors ended up being down, with the more defensive areas, staples, healthcare, utilities, depending on how you qualify that, they ended up being down. Now, communication was not up, but it's been holding up a little bit better as the market's been having some problems. So we saw some positive things where the Nasdaq got above 18.9, then 19,000. Okay. Utilities had a bearish MACD crossover. If you use utilities as a defensive gauge, that's probably more positive. But the financial sector, it had a BPI cross below 80 and a bearish MACD crossover. The dollar did get back above 100, but it didn't close there. And the Dow was able to get back above 42,000. Here's the market carpet. This is kind of what kept things more positive here. Nvidia ended up being up. Apple was down, but slightly. Microsoft was up half a point. Discretionary, we see where both Amazon and Tesla were positive. Communication, Google and Meta, even though Meta was barely up, but this kept things a little bit better looking there. Where you look through the other sectors and you see pretty much red. There's blue areas in here, but the bigger the box, the more impact it has on the S&P 500. We're still below the 200-day moving average with the Dow, and we're still negative with the Elder's Impulse system for the diamonds. Coming down a little bit, but still above the moving averages with the NASDAQ, and we continue to be neutral with the NASDAQ with the Elder's Impulse system. Coming down a little bit here with the NASDAQ 100, and also still neutral with the Qs with the Elder's Impulse system. Momentum is still positive, but we are rolling over. The PPO here, which is what I use to do the momentum for the NASDAQ 100, we were getting a really high reading here. And so this is working off this extreme reading. And coming down again here with the small caps. They weren't down all that much, but they really took it hard in Wednesday's session. They're still above their 50-day moving average, but continue to be below the 200-day moving average. And then we look at the Russell 2000 small caps coming back down to about 50 with the RSI. Again, still below the 200, still above the 50, but the momentum is starting to roll over. Negative with the Elder's Impulse system for the small caps, still cannot get above the 200-day moving average with the mid caps, and now falling back, and they were down slightly. Negative with the Elder's Impulse system for the mid caps. We did pull back with the Wilshire, but we're still above both of the moving averages, and we're above both the moving averages with the other broad market area that we look at, the total US stock ETF. Financial sector was down, but still the trend is looking a little stronger with the blue line further away from the red line. And we're still above both, even though price is declining. And the FANG index just going sideways right now. But this is actually helping this chart improve. As long as we're above both these lines, you can see the blue line, the 50 period moving average is starting to come up. And the 200-day moving average is actually increasing as well. And so if we see a golden cross here, that will help this chart look more positive. So Apple it's in a downtrend and it was down 1/3%, dropping below its 50-day moving average. In a downtrend with Amazon, but still above both the moving averages. Microsoft was up 0.5%. Again, since they reported earnings, they've been doing quite well lately, but they are in a downtrend. Google is in a downtrend and it was up 1 1/3%, trying to break above its 200-day moving average. Meta in a downtrend as well, but still above both the moving averages. Nvidia above both the moving averages, but in a downtrend. Tesla bouncing back up here, but also in a downtrend. And Netflix was actually down a little bit. Strange day when it's not setting an all-time high. Still seeing a bit of a flattening here with the correlation in the short term between US and world stocks, and tending to go up slightly here with the longer term correlation. And we came down with oil. Now we're getting closer to the 60 level. So there's rumors about things happening in the Middle East. It doesn't seem to be having an impact on oil. And the dollar, it did get back above 100, but it didn't close there. And we're still in a downtrend. Then we are coming in just a little bit under that 2% level with the trueflation reading on what is inflation looking like according to how they calculate it. And we're still above 4.5% with the 10-year yield, even though it did come down. So we want this to drop below this red line, which on this chart is 45. That's 4.5%. If it would drop back down, that could probably give some support to stocks. And we're still coming up and now having a hard time getting back above the 200-day moving average with the 10-year based on price. And then still looking okay here, getting some hits along the way with the growth to value ratios, but we're still above these moving averages, so they continue to go up. We're seeing that same thing with the large caps, mid caps, and small caps. So what's the outlook for Friday? Because of where we are in relation to the various moving averages, we are still positive in the short, intermediate, and long term. We're just going to get new home sales coming out. That's it for Friday's session. And then anything geopolitical, Russia, Ukraine, India, Pakistan, things in the Middle East, Israel, Iraq, excuse me, Iran, my goodness. Okay, and then, yeah, home sales, that's the only thing coming out. And this is what they're looking at here for the forecast, about 700,000. Seasonality, neutral to negative with the Dow and the Nasdaq, where we're neutral to positive with the S&P. Not a real clear advantage. We are still up 2/3 of the time in the week after options expiration, which will be finishing out on Friday, where we're down about 1/3 of the time. And then we do see a little bit more positive seasonality during a post-election here. We're following mainly the green dash line. The market will be closed on Monday, so have a nice barbecue that day. We do see a couple of days of negative post-election year seasonality before we tend to bounce up going into the end of the month. And here are the pivot points which have been updated on the YouTube community tab. So now I've switched this over to the negative side because depending on how you look at accumulation distribution, we're above the moving average if you're more conservative, but we are weakening and we're below the moving average when you look at the boom indicator, where now we're turning negative with the Chaikin money flow and the Chaikin oscillator. And we're still longer term negative with the growth to value ratio and discretionary to staples, but the ratio is still above the moving averages, so they are still improving. We're negative with the S&P and NYSE McClellan oscillators. They're both below zero, so that means the summation indexes are going down. Parabolic SAR is negative, as is the bullish percent index. Even though it's extreme positive for the S&P, it's below its moving average. And the Copic curve is now below its moving average, declining after being extreme positive. We dropped back below 50 with the 200-day moving average study. The swollen trading oscillator continues to decline and is now dropping below zero based on price and volume. And the long-term special K chart, even though it's trying to turn back up, is still below the red line. All right, on the positive side, though, we still have the NASDAQ 100 and the NYSE bullish percent indexes, which have been holding up a little better. And we're still looking good with the 20 period moving average study, but it's extreme positive. So it's coming down a little bit there. The oscillators, they're rolling over, but they haven't switched over negative at least yet, except for the slope oscillator. That's the only one that's really turned negative for right now, but we don't have confirmation from the other short-term oscillator, the TSI. Ease of movement is still positive, as is the money flow, the ultimate oscillator. We're seeing weakness in the vortex, but it's still positive. Financial sector is positive, and the momentum, though it's weakening, it's still positive for the NASDAQ 100. So our conclusion, we are still positive in the short, intermediate, and long term, but we're still declining from being quite overbought at this point. The market still seems a little bit vulnerable, still showing some signs of weakness. We need to see some convicted buying coming back in to help turn things back more positive. That's pretty much what we're seeing in the intermediate term, and we're still positive in the long term. Even though we're in a downtrend, we're above the 200-day simple moving average. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.